Yeah, I think it's a bit of a tricky one. Taken at face value, this was a very strong report, much stronger than expected across the board, whether it was payrolls, whether it was unemployment, whether it was wages. The two surveys, the household and the establishment survey, were strong. So this, I think, unquestionably will have an impact on people's assessment of the US economy. But I think there is just one warning. This data set, the employment report, tends to be one of the least reliable pieces of data. There are big revisions in the months following, and then even a year later, as we saw earlier this year, you can get big revisions. Other indicators about the jobs market, for example, the employment components of the ISM manufacturing and services sectors weakened in September. The ADP jobs number was nowhere near as strong as indicated in the data we got on Friday. So yes, I would say it was a positive number, but I think we need to be a little bit cautious about running too far ahead with the implications. But of course, it's natural that the dollar has strengthened. It's natural that the bond market has marched back from some of the very aggressive assumptions that were previously priced in. And those 10-year yields at 3.7% always struck me as too low, and that they probably in 12 months' time would be higher than that.
Okay, so Paul, walk me through the market reaction function here. I know you and I have spoken before about your call for a sell-off in equities, a widening of spreads. How do you reconcile that with this strong jobs print in the US?
Well, I think, again, if you take it in isolation, and this is the only thing that you look at, it doesn't add up. I would be rapidly changing my view. But as I've said, this piece of data by itself tends to be quite unreliable. We saw there were actually upward revisions to some of the previous months, but equally we go through these cycles where we get some upward revisions, then a few months later we get downward revisions. So I think taking a broader view of the US economy, I still think that it is on a decelerating trend. So and when you look at where high yield spreads are, they are amazingly tight at the moment, which is usually consistent with very strong economic performance. And I don't think we're there. So I'm happy to remain on the sidelines as far as high yield is concerned. I think the US stock market, for me, the problem is much more the concentration and the valuations. And starting from the valuation levels that we see in the US market at the moment, with a cyclically adjusted PE above 40, I just think that over the medium to long term, it's hard to generate good results from that. And I far prefer, and I have done for some time, markets such as China, where the valuations are far more reasonable.